Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories in corporate filings. Today we're diving into Applied Optoelectronics' latest report, and let's just say they're looking to raise some serious cash. It seems like they've inked a deal that could bring in $250 million. This isn't just a little funding round, it is a significant move, and we need to break down what it means for the company and its shareholders. We're looking at an 8K filing, which is basically a current report used by public companies to announce major events that shareholders should know about. The big news here is about a new agreement designed to boost their capital. The core of this report is a new deal the company has entered into. They've signed an equity distribution agreement. Think of this as a way for them to sell their company stock, their shares, to investors whenever they want, up to a certain amount. What is really eye-catching is the sheer amount they could raise, up to $250 million. This means they have the option to sell a lot of their company's ownership or shares to the public. So how does this work? They've partnered with two firms, Raymond James and Associates Incorporated and Needham and Company Incorporated. These are essentially their sales agents. They'll act as go-betweens, finding buyers for the company's stock. The agreement allows them to sell these shares at the market offerings. This is a pretty common method where the company can sell shares through stock exchanges, like the Nasdaq Global Market, where their stock is traded, basically at the current going price. The company has a lot of control here. They get to decide how many shares to sell, when to sell them, and at what minimum price. They can even stop the sales completely if they decide to. This flexibility is key to managing their cash flow and market perception. Now, let's talk about the cost of this convenience. The sales agents won't be working for free. They'll take a cut of 2% of the gross sales price for every share they sell. On top of that, the company will cover certain expenses like legal fees and filing costs up to a certain limit. There is also a clause about what happens if things don't go as planned. If the company has to end the agreement under certain conditions and hasn't sold a minimum amount of stock, they might have to pay back the sales agent's expenses, up to a significant amount, $30,000. This shows there is a level of commitment expected from the company. This whole offering is being done under a registration statement that was already filed. This means the shares they plan to sell are already approved and registered to be sold to the public, making the process smoother. Let's look at their stock. They've got common stock trading under the symbol ABOE on the Nasdaq Global Market. This equity distribution agreement is essentially a way for them to generate capital from that traded stock. So, what is Applied Optoelectronics Inc., a company that makes things like fiber optic transceivers, which are crucial for high-speed data transmission? They operate in a competitive tech space, and companies in this sector often need capital for research and development, expanding manufacturing, or even acquisitions. Raising capital through stock sales is a common strategy, especially when the company believes its stock price is fairly valued or if it needs funds to seize growth opportunities. This $250 million infusion could be for any number of strategic initiatives, like developing new products or expanding their market reach. Now, looking beyond the agreement itself, I want to get a sense of the company's financial health. While this report doesn't contain detailed financial tables, the very act of securing such a large potential capital raise suggests the company might be looking to fund significant growth, or perhaps navigate some market challenges. Companies typically raise capital when they anticipate needing it for expansion, to pay down debt, or to weather economic downturns. Without the detailed financials here, it is hard to pinpoint the exact reason, but it signals a proactive approach to funding their future. From my perspective, this move is a double-edged sword. On one hand, having access to up to $250 million provides Applied Optoelectronics with significant financial flexibility. This capital can be a powerful tool for innovation, strategic acquisitions, or strengthening their balance sheet. It shows ambition and a desire to grow. However, issuing more shares can dilute the ownership stake of existing shareholders. If the company doesn't use this new capital effectively to grow earnings and increase the stock price, the dilution could be detrimental in the long run. It is a gamble that hinges on smart execution and favorable market conditions. The key question becomes whether the company can deploy this capital in a way that generates returns significantly higher than the cost of dilution. Alright, that is our breakdown of Applied Optoelectronics' latest filing. What is your take on this capital raise and what it signals for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.